to see my code assignment
Did I get a chance to do what?
to look at to see my email. I sent you an email about the last assignment because I was sick the whole week, and I told you if I could send it maybe by the beginnings of this week.
Oh, yeah, go ahead. That's fine.
Okay, thank you.
Okay. Anyway, we'll wait a couple of seconds for everyone to show up. So this is the 5th session. And this one, now, by the way, here's some good news, because this one is a little bit more theoretical than the other ones. There actually is no assignment for this week, because it would have been very difficult to write any kinds of reasonable questions for this type of materials. So instead, we'll just go through and see what this is all about. And then next week, I think we're going to start doing some pricing in Excel. And so that definitely will require some, that's a different matter altogether. We'll be doing an awful lot of Excel next week. But this week, because this material is very theoretical, there is no assignment at all. Okay. So I was just making sure I didn't hit the wrong button here. Anyway, so here it is. So let's take a look. So here's what we're going to do. We're going to look at the factors that determine the value of an option before we start to try to put those into an equation form, and which we'll be doing next week. We're going to see some theoretical limits on how high or how low option prices can go. We're going to talk more about arbitrage, although we've certainly already discussed it. It's going to become more important than ever in this chapter, because a lot of the results are based on this concept of arbitrage. In other words, if any of these results that I show you are violated, that would lead to arbitrage opportunities. And then finally, we're going to introduce this very interesting idea called put call parity, which ties together the prices of European calls and puts that are identical in every way, except for the fact that one is a call and one is a put. All right, so what factors influence the price of a stock option? So let's focus our attention here on stock options. So basically, if you were to let's say, put together a model of some type that you hope would price an option correctly, what variables would you include in it? Well, you've got the price of the underlying asset, which in this case is a stock, the strike price, of course, the time until the option's maturity, volatility of the stock price. We'll explain that in a second. The risk-free rate of interest, and we need that for discounting future cash flows. And then we also have to consider any dividends that may be paid by a stock during its lifetime, or at least during the lifetime of the option. Now, volatility, well, actually, yeah, here we go. I already had a discussion here. Volatility refers to how much the price of the stock changes over time. So you can see on the left, we have a stock that over time doesn't change too much. And so we say that that stock has very low volatility. On the right, we have a stock that's constantly bouncing up and down. And we say that that stock has very high volatility. And we're going to find out tonight and in future sessions that more volatility is actually beneficial to an option. In other words, the more volatile the stock is, the more expensive the option will be. Okay, so volatility is good for options. So now here's an explanation. A call on stock A has a strike of 100 and it matures in a month. The stock is currently selling for $90. There's a very low probability that this option will end up in the money because, let's face it, it's a large change that we need in order for this option to finish in the money. So that means this option is going to sell for a very, very low price. It could even be a matter of pennies. On the other hand, I didn't realize until just a second that these are descriptions referred to this diagram. Okay, stock A is the one here. It changes so little over time that if it's currently at $90, I need, in order for me to have a positive payoff for my stock option, I need the stock price to at least reach 100, of course. But there's only a month until the maturity date of the option. So given how stable the price of this thing is, the chances of it moving above $100 are pretty low. Okay, so that means that people will only pay, like I said, maybe pennies for this option because the chances of it finishing in the money are so remote. But with stock B, given the way it bounces around like this, imagine that stock B is also selling for $90 and the strike price is 100. The probability of stock B or the option on stock B finishing in the money is much higher, I think you'll agree, than for stock A. There's a fairly decent chance that stock B could rally and move up above $100 by the time this option matures. So what that indicates is that investors should be willing to pay more for option B than option A. Okay, in other words, the option to buy stock A will have very little value under these circumstances, and the option to buy stock B will have maybe not a large value, but certainly a higher value than for stock A, because the chances of it finishing in the money are significantly higher than for stock A, and it's all about the volatility. So in other words, because having a very volatile stock greatly increases the chances of finishing in the money. Now, the flip side of that is that it also increases the chances of finishing out of the money. But remember, when you're out of the money, you're going to get a payoff of zero, whether you're $1 out of the money or $50 out of the money. It doesn't really matter. So there's an asymmetry there between the upside and the downside with an option. On the upside, we have unlimited potential. On the downside, we are limited in our losses to how much we paid for the option. So anything that increases the likelihood of a very large price change in the stock, on average, will work in our benefit. Okay, so that's why the option on stock B is going to be more expensive than the option on stock A. All right, anyway, so I did mention this chart. So this list of factors that influence the price of a stock option. So I've got a table here that summarizes these factors. Now, the pluses and minuses are there to tell me that, for example, this first one, this plus means that if the stock price goes up, the value of a European call goes up, as does an American call. It also means that the value of a European put goes down, as does the American put. The strike price is the opposite. The higher the strike price is, the more valuable a put is, the less valuable a call is. Okay, and you can see the pluses are associated with the puts and the negatives are associated with the calls. Okay. Now, the time to maturity is a tricky one. In general, more time to maturity is helpful to an option. But there's some very specialized cases with European options, which we'll discuss later on, where having more time to maturity actually can be harmful to the option. But they're extremely rare. These cases are very rare. For the most part, the more time there is until the option's maturity, the more valuable it'll be. Okay, it's very unusual that you have the opposite. So that's why these question marks are here, to indicate that it's not always the case that more time is beneficial to a European call or put. All right, but except for those rare cases, almost without fail, more time is beneficial to both calls and puts. Well, you can't have unlimited losses with shorting a call. Actually, yes, you can. Because when you're short a call, you're obligated to sell the stock to the buyer of the call at the strike price. Okay, so in other words, if the strike is 100 and the stock price goes up to 500, then what you're required to do is sell a $500 stock for $100. Now, don't you get shares assigned? You have to buy them back. No, it doesn't work that way. What we're describing here is what's called a naked call, which means you do not have a position in the underlying shares. It means that if the buyer of the call exercises the option, you have to go out in the market and buy the shares to deliver to them. Now, if you already own the shares, it's a different matter altogether. If you already have the shares, then the worst thing that can happen is you have to deliver them to the buyer of the call. And so that dramatically reduces your risk. But if you don't already own the shares, you could potentially be forced to go out in the market and buy these shares at an incredibly high price and yet deliver them at this strike price that you agreed to. So yes, in theory, there's no limit to how much you could lose if you're short a call option. With a put, you're limited by the fact that the stock price can't go below zero. But that is the only thing that prevents you from having unlimited potential losses. This thing is in the way. No, there are no margin calls with options. That's only for futures. Yes, if there were margins in options, yes, then there would be some kind of an margin. But the thing is that the marking to market only takes place once a day. So by the time the day is over, you could have really gotten clobbered. And if you now can't also match the margin that you're required to put into your account, you could have your position wiped out. But you could still pile up enormous losses during a single trading day. But you only see margins with futures contracts. All right. Anyway, so yes, now volatility, as we discussed, across the board, that's beneficial to all types of options. American, European, call, put, it doesn't matter. Volatility is helpful. The risk-free rate of interest, and again, we'll discuss this in a few minutes. Higher interest rates are helpful to calls, and lower interest rates are helpful to puts. So it has to do with what you're being given the right to do versus taking a position in the underlying security. Now, the dividend, the way to think about the dividend, the impact of the dividend is that when a share or a corporation declares a dividend on its shares of stock, let's say Apple declares a $2 dividend. The minute that happens in the market, the price goes down by $2. If not, there's going to be an arbitrage opportunity. So the declaration of a dividend, since it lowers the stock price, that's going to hurt calls and it's going to help puts, okay, because it forces the price to go down by the full amount of the dividend. So that's why the dividend payoffs look, or the signs look like this, because the impact of a dividend is while the shareholder does receive a cash payment, the price of the stock itself is going to go down by that same amount. So that's going to have a direct impact on calls and puts. So anyway, so we're going to look at these factors one at a time. So the stock price. Now, of course, I reminded you here what the payoff profiles look like. So because the X is a fixed constant, that means that if S goes up, the call payoff, then the gap between S and X is going up. And so your payoff goes up, and therefore the value of the option has to go up. So a higher stock price is beneficial to a call, but the opposite is true for a put. Because here, if you notice, it's max X minus S and 0. So if I'm increasing S, that means I'm subtracting a larger number, and that makes this less valuable. Okay, so the strike price is exactly the opposite of, as we've already discussed. Okay, now we've already seen this, by the way. In fact, why don't we go back and revisit that website where we can look at option prices, just to make sure that all these things are true. You can see the effect with current option prices. We might as well stick with Apple. Let's give this thing a minute to wake up. Here we go, Apple. And we're going to look at their options. any minute now. You know what it is? It's these crummy ads. Yeah, this is one of the negative things about finance. So many ads, and that just gums up. It just gums up the work. You can see about this little spinning thing, it's still going. Well, you notice how it always has enough bandwidth to show you ads. Here it is. All right, so we can't do anything about the price. We can't directly look at different stock prices, but we can look at different strike prices. So for example, let's pick, given that today's price is about 153.83, let's pick a couple. A call with a strike of 140. Let's see, the one that you're actually paying the higher of the two. All right, I'll tell you what, let's just look at the last price. Okay, the last traded price, we'll compare that. So the 140 strike has a price of 14.18. If I look at the 150 strike down here, it's only $4.55. So we have 14.18 versus 4.55. Now, what's interesting here is that when I increase this strike price by $10, if you notice, the call price went down by less than $10. Okay, and we'll take a look at that in a few minutes too. Why is this happening? Why is it going down by less than the full $10? And well, I'll give you a hint. It has to do with something called the time value of money, the probability of it finishing in the money. But so as you can see, as we keep increasing the strike price, like if you go down here far enough, even at 170, that stock is only, that option is only selling for a penny. Now that's because this option matures in about 4 days. So they're basically saying here that even for Apple, reaching 170 in 3 or 4 days is not likely to happen. That's why it has so little value. But on the other hand, if you spend a penny on this option and it actually does go above 170, let's say that brings the price of the option to $1. You just turned a penny into $1. So that's a rather sweet rate of return. So some option strategists do exactly this. They go out and they look for options that have very low prices and they buy them because once in a while they might make a huge rate of return. You never know what could happen. Let's say there's suddenly a huge announcement tomorrow that Apple says, look, we discovered that our profits were understated last year. Here, we really made more than we thought. Well, that might just do the trick. Now with the puts, everything works in reverse, of course. You see that with these low strikes, the option is kind of not very valuable. Even as, let's see, 145. Now that's only about $8 below the current price, and that's only selling for 11 cents. So that means that it doesn't look like the price is going to go down in that neighborhood anytime soon. Investors only willing to pay 11 cents for that. The possibility of it going down below 145. And as the strike keeps rising, though, like to 155, now suddenly the price is 244. As we keep raising that strike price, we're going to like at 205, we have to pay 59.20 for this put option. So as you can probably guess, the strike has the opposite impact on calls as puts. Okay, so the high strike, we have very cheap calls, but very expensive puts. Time to expiration. Now, all other things being equal, like we saw, except for those very rare cases, which we'll get to eventually, more time means an option is more valuable. So here, why don't we do this? This chart can show us options that are available at with different maturity dates. So let's pick the 150 strike call, 455. Let's say that we do the same thing for May. So instead of $4.55, that same call is now worth $10.75. Okay, because instead of maturing in a few days, all of a sudden we're looking at 2 months. So you can see it has a huge impact on the price of the option. And this will be true for calls and puts, except there's a few strange cases where that's not true. But for almost all of the others, more maturity, longer time to maturity indicates a more valuable option because there's more time for it to finish in the money. So that's how maturity works, or time to expiration. Volatility. Now, by the way volatility is defined, what we're actually doing is we're taking a historical time series of that stock price. We're calculating rates of return during that period, and we're calculating the standard deviation of those returns. That's what this volatility number represents, the standard deviation of the returns of the stock. In fact, I'll tell you what, just to give you a little detour into this world, I'll just quickly show you what volatility is, or how it's calculated, I should say. So imagine that we'll have a very simple case. Year zero is today. We're going to look at our holdings of a stock. From year 0 to 10. Here's the price of the stock. And of course, I'm completely making these numbers up. There we go. Okay, so those are the prices. Now, these are the rates of return on an annual basis. For that, we need 2 consecutive observations, and we're really just calculating the percentage change from one year to the next. So those are the returns. You know, we had some good years. We had a few losses, but on average, we're doing okay. Now, so the volatility of the stock over this period is the standard deviation wait a minute. I was starting to forget how Excel spells that function. Okay, see now this is 2.9%. That is a very low volatility. That's not very realistic. You know, let me do something here. Oh, okay. About now it's 12.5%. That still sounds pretty low, but I mean, so what you're seeing here is that you're basically taking the returns, a time series of returns, and then you're calculating the standard deviation of those returns, which I'm guessing you picked up somewhere in your travels. Standard deviation is simply a measure of the risk of an asset. And so the volatility on an annual basis is about 12.5%. And just for as a side note, there exists an index, the CBOE, in the, I'm going to say maybe the early 90s, created a volatility index known as the VIX. which is, it's all it means is volatility index, which is based on and we'll discuss this in a later chapter, by the way, implied volatilities. We need to get into the pricing models before we can explain this properly, but implied volatilities of Standard & Poor's 500 in options. And if you want to look at this index, you can go to this excellent website called FRED. Now, FRED is the Federal Reserve Economic Database, which is published by the Federal Reserve Bank of St. Louis, and say, listen, Fred, please show me the VIX index. And they'll say, no problem, here it is. Now, at the moment, it's at 1849, which means 18.49%. But remember, it's based on not just a single stock. It's the entire S&P 500. So it's trying to show you the overall volatility of all the stocks in the economy. And one of these days when it wakes up, it'll show us a graph which shows us what the index has looked like. Here we go. Now, what you'll notice here is that while it's right now it's in the teens, there have been times like here during the COVID, it spiked up to 66%. So if you look at, oh, by the way, let's go back to the max. It's been around since the early 90s. And what you'll notice is that pretty much it goes to the roof during crises. Like this is the housing crisis in the late 2000s. This is the crisis around 2001, the internet bubble bursting and all the rest. And then over here is the COVID, which brought it up to 53, 54. And then, you get these other spikes as well, but it kind of hovers around down here in the teens much of the time. And then it tends to go up when things aren't going so well. Now, here's a fun fact. You can actually buy options and futures on this VIX index. So why would that help you? Because if you're seeing a lot of market turmoil coming up, but you don't know which stocks you might want to buy, you can just buy a call option on the VIX. And that means that if the VIX index goes up, because markets are in turmoil, you'll make money no matter which stocks go up. So it's kind of an interesting tool to have access to. What's interesting about this index is that it wasn't the idea of the CBOE to do this. There was a professor of finance at Duke named Robert Whaley who wrote a series of papers about why there should be a VIX index. And I guess somebody at the CBOE saw that and said, we could do that here. And the rest is history. So that's what this is all about. But it's a very valuable tool to keep track of what's going on in the economy. And you can see these enormous spikes always correspond to rough times in the economy. So anyway, that is that. By the way, now this may not mean anything to you at the moment. It will when we start looking at the pricing models, but those curves are meant to represent the normal distribution. The black one is the normal distribution when it has a very low amount of volatility, and the green one is the normal distribution when it has a very high level of volatility. And the red line is the payout to a call option. And so what you're seeing here is that the green curve has more area to the left of red. Now, what you're looking for is you want to be as high above X as possible. So I don't know if this graph is really helping or not, but what it's showing is that high volatility gives us more of a push into the high payoff territory. It also pushes us or gives us the higher chance of finishing out of the money. But out of the money means you have no payoff. It doesn't matter how far out of the money you are. So when you're in the money, as the price keeps going up, you keep making more and more money. When you're out of the money, it doesn't matter how far out of the money you are, you're just going to wind up with a zero payoff. So anything that increases the likelihood of a very large stock price or a very small stock price, on balance, is going to work in your favor, whether it's a call or a put. Anyway, the risk-free rate, that's usually taken to be the yield on a treasury security whose maturity matches the option. All the results in option pricing theory are based on risk-free rates because we can set up completely risk-free portfolios and exploit arbitrage opportunities if we need to. So the risk-free rate is the one that's relevant to discounting cash flows from options. So the risk-free rate here is, like I said, just the treasury yield for whatever maturity the option happens to have. Now, as it turns out, a higher risk-free rate helps the owner of a call option and reduces the price of a put. So we're going to have a quick example here of this. Basically, the way to think about it is, let's see. Well, actually, there's a couple of ways to think about it. Let me try this one first. Okay, well, think about this. The owner of a call option has the right all right, let's do that first. So the payoff to a call option now, what happens with the call? And by the way, the concept present value, of course, just means the amount of money that must be saved today to be worth a specified value in the future. So in other words, let's say that a quick simple example, for example, if an investor can earn 5% return from a bank account and would like to have $20,000 available in 5 years for down payment on a house, how much must he put in the bank today to have $20,000 in 5 years? So in other words, you want to get that new house, that dream house, but in 5 years, you'll be ready to move. And you want to buy that house, but you know you'll need to have a $20,000 down payment. And the bank that you go to pays you 5% per year, assuming, to keep it simple, annual compounding. Well, the way you would figure that out is you would take your $20,000 so in the denominator, you have 5 for 5%, and you have an exponent of 5 because that's the number of years. It's not like Word. Word has an actual button for this. I don't know why they can't do that in PowerPoint. Okay, let me work out. Oh, there's a calculator right here. $15,670.52. Okay, so this This is the present value of $20,000 to be paid in 5 years. So in other words, I have to put 15,670.52 in the bank now to have $20,000 in 5 years. So we call that 15,670.52 the present value of the $20,000. Now, as far as options are concerned, we know that the payoff to a call option is max S minus X and 0. But the strike price is not paid until the maturity date of the option. So the present value of the strike price to be paid in 5 years is, well, okay, one way you can figure it out. Oh, wait a minute. All right, let's say the option matures in 1 year. It's not likely to be 5 years. If the option matures in 1 year, then the present value of the strike price will be, and we're assuming again a 5% rate of interest. I don't know what the hell's going on. My mouse is not working all of a sudden. Something's not working. I must have hit the wrong key at one point. I can't, I'm trying to get back to where I was. This is just unbelievable. And also assuming a rate of 5%. Okay, so that means in today's dollars, the amount that I'll have to pay to buy, exercise this option is X over 1.05. So next year, if I exercise the option, that means in today's money, it's worth X over 1.05. If the interest rate rises to, let's say, or I'll tell you what, let's use a numerical value. If X is 100, then this present value is 100 over 1.05, which is $95.24, let's say. If the rate goes up to, let's say, 7%, then the present value of the strike price falls to 100 over 1.07 is 93.46. Okay, so either way, you're still paying $100 when you buy this stock with your option. But from today's perspective, the cost of buying the underlying stock has declined. I shouldn't say the cost, the present value of the cost. So therefore, the option has become more valuable. Now, I think a better way of thinking about this is to look at it like this. The owner of the option has the right to buy an asset in the future. This, like for example, suppose that a jewelry manufacturer will need to buy gold in 6 months and enters into or buys a call option with a strike of $1,500. Also assume, just to keep it simple, that the current spot price of gold is 1,500. Okay, so just to keep it simple, it's 1,500, and we have the right now to buy it in 6 months for 1,500. So this is what we're trying to get at. I think this might be the clearest way of explaining this. The owner of the option, in order to guarantee a price of 1,500 for the gold, the hedger, the manufacturer, I guess, can buy the gold today buy a call option to buy the gold in 6 months. Well, what I'm thinking of is this. Yes, you could do that. If you take the same $1,500 that you're not using to buy the gold today, you could, for the next 6 months, earn the risk-free rate of interest, and then in 6 months, actually buy the gold. So if you have the money on hand already, you can just buy the gold and be done with it, or you can buy the option and invest the money, as you say, for 6 months. And during that period, you'll earn the risk-free rate of interest. Let's say you buy or invest in a 6-month treasury bill. If you don't already have the money, the way to think about it is that buying the gold today would require you to finance it with borrowing. So you'll spend interest over the next 6 months repaying your position. So either way, the option means that you do not have to finance your position for 6 months. You are either going to save interest by not having to borrow, or you're going to earn interest by being able to invest it instead of buying it directly today. So the option is, in effect, saving you 6 months worth of interest, any way you look at it. So therefore, if that's true, the higher the rate of interest, the more beneficial this is to the owner of the option, and therefore the more expensive it'll be. Yes, that's right. Okay, because it reflects the opportunity cost of not having to finance your position. And you'll see, in fact, you're going to see in a bit that the upper and lower limits to option prices do include not the strike price itself typically, but the present value, because that's the number that's actually relevant. All right, so yeah, that was, now by the way, but maybe you can see now the logic behind why this works in reverse for puts, because with a put, you're postponing the opportunity to sell the asset for 6 months, which means you're giving up the opportunity to invest that money for 6 months. So with a put, higher interest rates are actually going to reduce the value of your position. Okay, so with puts, instead of the option giving you the ability to save interest, the put is actually forcing you to pay interest, or at least give up the opportunity to earn it. So therefore, with puts, higher interest rates actually reduce the value. So in a lot, by the way, in a lot of these cases, the way we have to think about the value of an options position is to think about what alternatives are there to acquiring our asset, what other ways could we have done the same thing? And what would they have cost us? And so, the true value of the option is what is it preventing us from having to do to get our hands on that asset at a guaranteed price? But all right, anyway, so I think we're done with that. Now, dividends, as we've already said, with a dividend, a payment of a dividend reduces the price. This is you know what this is? This is an explanation of why there'd be an arbitrage if the stock price doesn't change by the full amount of the dividend. So in other words, that's an interesting question. If the stock price, let's say, an investor owns a stock that's currently selling for $100 today. And in 6 months, a $2 dividend is declared. If in principle, the price should fall to $98. If it doesn't, let's say it only falls to $99. Well, we can collect the $2 dividend and sell the stock for $99, and we'll end up with $101. If the price does drop by $2 to 98, by buying the stock for 98, we collect the dividend. Wait a minute. I'm trying to remember what I did here. I guess I scribbled out this example the last time I did this class, and I see it looks like there's something missing. So what's happening here is that the price is supposed to fall to $98 in 6 months. Now, the collector, whoever owns the stock on the day the dividend is declared, actually is the one who gets to keep it. Even if you own the stock for 10 years, it doesn't matter. Whoever owns it on that date gets to keep it. So all right, I think I see what I was doing here. Let me see if I can clean it up a little. So you have, here's the stock. Here's today. The stock is at $100. In 6 months, $2 dividend is declared. So theoretically, the stock price should fall to 98. If it does, well, that is what you would expect, because you could buy the stock for $100 and you collect your dividend, and then you could sell the stock for 98 and you'll still end up with $100. But if the price drops to 99, so we're assuming that you can still buy the stock for 99. We're making a lot of assumptions here. Collect Jesus, let's me take a look at this one more time. I think what they're assuming here is that you are able to just the day before the dividend is declared, you can buy the stock for 100. Or even during the same day, if you are this takes place during a single trading day. Buy stock for 100. Collect the $2 dividend. And then resell the stock immediately for 99. Well, then you've converted 100 into 101. And just because you bought it just as it's declaring the dividend, you've made a risk-free profit. Whereas if it fell to the proper 98, then you would just break even by doing this. So anyway, but the idea here is that the price should fall by the same amount of the dividend. So that simply means that because this is happening, when the dividend is declared, the price of the stock goes down. And of course, we know that that lowers the value of the call and raises the value of the put. Okay, so that there shouldn't be any mystery about that one. Anyway, so now we're going to be looking at these theoretical upper and lower bounds for option prices. Now, we can prove that these must hold by showing what would happen otherwise. In other words, we can show how you would earn arbitrage profits if these relationships are violated. So we don't have a pricing model for calls and puts yet, but what we can do is establish upper and lower bounds. Now, lower bounds may be 0, but they don't have to be. The upper bounds could be very, very high. But what we will need to be able to show is that if the price falls outside of that range, then we can earn arbitrage profits. So now, of course, we already know what arbitrage is. It's the opportunity to buy something that's undervalued or underpriced, sell something that's overpriced without taking any risks. And we typically do this with borrowed money. And so it's free money. Now, of course, we know that in an efficient market, this is not going to happen, but we know that such things do happen even now because computers are set up by hedge funds to look for these opportunities. And if the computers are fast enough, they can grab them just before they disappear. The only problem is usually the profits are fairly small. So these positions often have to be financed with a lot of borrowing. And this is how these places get wiped out, because if something goes wrong when you have finance your position with a lot of borrowing, then you could end up losing an enormous amount of money, more than you started out with. So what we're going to show, we're going to start by showing that, oh, by the way, going forward, in order to, we have to make a distinction between European and American calls and puts. So we're going to use lowercase c for European calls and capital C for American calls. So what this is basically saying to us is that the asset price itself always has to be worth at least as much as the call, the American call, which in turn has to be worth at least as much as the European call. And if you notice, we have these little equals here, which means we're allowing to consider the possibility that under some conditions, that an American and a European call may actually have the same value. In fact, we're going to derive a very strange result, which shows exactly when this could happen. In this case, we're assuming it's a stock option. So in other words, the right to buy a stock can't ever exceed the value of the stock itself. And that's fine to know, but we'd like to be able to set up a portfolio and show how arbitrage would work if somehow this were violated. So let's just say that somehow the American call became more expensive than the stock. So what you would do, if you look at this, C is greater than S. S is the undervalued. You're buying S and you're writing or selling C, okay, because S is too cheap. C is too expensive. Now, if we can demonstrate with all arbitrages, let me just make a side note here. If we can earn a positive cash flow today without any negative cash flows in the future, that's an arbitrage. Okay, so you notice how it says no negative cash flows. In other words, if we can put money in our pockets now, and in the future, either we have no more cash flows at all, or at least, or possibly some positive cash flows, that means it's an arbitrage. So here, we know already that because the C is more expensive than S, if we buy C and if we buy S and sell C, already we put the difference in our pocket. The question, though, is proving that in the future we will not have any negative cash flows. If we can do that, then we're all set. All right, so here's what we're going to do. We're going to create a little table. So there's two possibilities, two scenarios. Let's say that the option matures in 3 months. On that date, either one of two things is true. Scenario one, the call option finishes in the money. Okay, and by the way, don't forget, we own the stock and we were short the call. So our position could be written as S minus C, or think of it as the payoff is S minus the max of S minus X and 0. If the stock price rises above the strike, we own the stock price, the stock, I mean. We have to make a payment to the call owner that we sold it to of S minus X. But algebraically, as you can see, S minus, in parentheses, S minus X is equal to X. The two S's cancel each other out, and we end up with just X, which is guaranteed to be positive. In the second scenario, S is less than or equal to X, the option is not exercised, there's no payoff. The call buyer does not exercise it, and we just get to keep the stock. Okay, so in the first case, we deliver the stock to the call owner. In the second case, we just keep the stock. Either way, we end up with a positive payoff in the future and a positive payoff today. So this is definitely an arbitrage. Now, this is an extreme case. The idea that the call could become more expensive than the stock is ridiculous, but what we're doing here is proving why it can't happen, because not even on a crazy day of trading, it can't happen, because that means that everybody in the market would jump in and they would start buying S and they would sell C. Actually, let me mention that right here. So since the strategy consists of buying S and selling C, this will drive up the price of S, drive down the price of C until C is no greater than S. Okay, and then this stops. Okay, so in other words, an arbitrage takes care of itself. It can't go on forever. The market prices will immediately adjust to all this trading, and then the positions will return to their correct levels. Okay. And that's going to be true for all arbitrages. They will last very little time because all the market trading will force the prices to return their correct levels. Or when I say correct, I mean arbitrage-free levels. Now, for a put, the maximum it can ever sell for is the strike price. And in turn, the American put is always worth at least as much as the European put. All right, so, by the way, this one should be pretty clear because you look at the payoff to a put. What happens if S is equal to 0? Well, then you end up with a payoff of X. So that establishes a maximum value for your option. Nobody would ever pay more than X dollars for a put when the maximum payoff is X dollars. So obviously nobody would ever be foolish enough to pay more than that. And they will all certainly end up paying less. Okay, so if S, we'll just make a note here, if S is 0, then the max of X minus S in 0 simply equals X. And so that establishes an upper limit to how much, how valuable that put can ever be. But we can also set it up as an arbitrage. Now, what we're going to need to do here, though, is because X is a constant, and again, this involves the present value. When setting up an arbitrage portfolio, with a constant value such as X, because now there's no such security, it is not an actual security. We treat it as a risk-free bond that will have value X dollars on the maturity date and is currently worth the present value of X dollars. So when you, if in order to set up a portfolio like this, you're not going to actually try to buy X. What you're actually buying is a treasury bill worth X dollars on the maturity date, which is currently selling for the present value of that. Anyway, let's set this thing up and see how it would work. So remember, the idea here is if this is our upper limit, that means we have an arbitrage if P is strictly greater than X. Put price has somehow gone above the strike. So what we're going to do is buy the put. We're going to sell the put because it's clearly overvalued. And what we're going to do is buy a risk-free zero coupon bond, meaning a treasury bill. And that value is X, or the discounted value of X now, it'll be worth X on the maturity date of this option. So all right, well, it's getting a little cluttered here. I'm going to write this out better on another slide. So, all right, here's what happened. So the condition is let's say that this upper limit because this is the case in the market. We found a put that's selling for more than the strike. In fact, if you want to go back to the Apple options, you'll see there aren't going to be any. Let's look at these puts. Let's say the strike is 80, the price is 4 cents. Now let's go down here. So like here, for example, the strike is 300, the put is only selling for 145.94. So in other words, if we saw that this price was actually $301, what we would do is what we're about to do now. We're saying, okay, we found one where P is too high, and we decided to take advantage of it by selling P and investing the present value of X in a treasury bill. So what's going to happen is there's two scenarios that can take place on the maturity date. So in scenario one, the put finishes in the money. And in scenario two, it finishes out of the money. So now remember, so what happens to our put? So the put, the short put, has a payoff of negative max, X minus S and 0. Okay. Now, because it finished in the money, we can write this as negative X minus S. But remember, we own the stock. I mean, we own the treasury bill. Negative minus X minus S is actually minus X plus S. But the treasury bill is worth X. So the total is minus X plus S plus X equals S, which is greater than 0. On the other hand, on this side, the short put is worth nothing. The treasury bill is worth X. And so the total is just X, which is greater than 0. So this is an unusual arbitrage because we made money up front and we're making money again in the future. But that's because this is an incredibly extreme case. Normally what ends up happening with an arbitrage is that the way it's structured is that it should provide no cash flows at all in the future, but puts money in our pockets right now. This kind of thing is ridiculously lucrative, but it could happen. So therefore, what this means is that you're never going to see the put price rise above K in the marketplace, or X rather, in the marketplace, because immediately people would exploit it and the prices would fall back to their correct levels. Okay. So also don't forget that by writing the put and investing in the 0 coupon bond, the initial cash flow is P minus X, which is positive. All right, anyway. Now, it turns out that the option cannot, the put can not only not ever exceed the strike price, but it can't exceed the present value of the strike price. Okay, now let's just quickly review what you're seeing here. What exactly is this expression? Well, just as a quick review, E is a constant that's approximately equal to 2.71828. R is the risk-free rate of interest. T is the time to the maturity date or the maturity of the option. X, of course, is the strike price. So what we're seeing here is the present value of X, but under a very certain condition, when R is what we call continuously compounded. Now, what does that mean? All right, so what happens is this. Suppose that a bank pays a 6% rate of interest each year. $1,000 invested for 1 year would be worth $1,000 times 1.06, 1,060. Now, in practice, the interest rate, it doesn't work this way. What they normally do is they pay it to you more often than that. So, for example, suppose that instead, the bank actually pays interest on a monthly basis. In other words, 0.5% every month instead of 6% per year. This is known as monthly compounding. At the end of the year, the investment would be worth. And so what you would end up doing is multiplying the $1,000 not by 1.06, but 1.005 raised to the 12th power, because it's 0.5% per month and 12 months. So that's going to give you $1,061.68. So all of a sudden you got that extra $1.68 in there. That extra $1.68 is referred to as compound interest. Whereas the first $60 worth of interest is called simple interest. So the distinction between the two is that the simple interest is based only on the original $1,000 investment or principal, The $1.68 is a result of paying interest on interest. Okay, so in other words, the interest you earn during the year is earning interest as well, and that adds up to $1.68. Now, in principle, we could continue to increase the compounding frequency as much as we want. In the United States, interest is typically compounded on a daily basis, at least in banks. So if you take your money to a bank, like a savings account, let's say, they're going to compound your interest every day. But in the limit, if we keep increasing this frequency, it reaches a limit known as continuous compounding. Which means that interest is compounded an infinite number of times per year. And if that's the case, then the formula changes. In this case, the sum invested will be worth. So here, what you're going to actually do is take your $1,000, and you're not going to use that formula at all. You're going to multiply by E, and your exponent will be R, the number, the rate of interest, and the time frame. And so I'm not sure this calculator has E to the X. This might be it right here. No, I don't think that's so good. All right, I'll just take a real calculator out of my bag. There's no point in fooling around. This gives me $1,061.84. Okay, so that is the theoretical limit. Did you see that on there? I didn't. That would work if I could see an E button here, but oh, there it is. Maybe that's what I was looking for. Oh, yeah, I didn't see it there. No, you know what? This is just E. Oh, is there an E to the X? Oh, that is so stupid to have E but not E to the X. I'll be damned if I see it. You see E to the X over here? I see 10 to the X, X to the Y. No, that's not going to work. I don't think, unless what they want. Oh my God, really? Is this what they meant? Oh, E raised. Oh, well, that is, I've never seen that before in my life in any calculator I've ever used. No wonder I couldn't figure it out. All right, let them have their ways. I'm going to use my calculator. Anyway, but what we're doing here is what we've just done here is calculate the so-called future value of the sum. We also can reverse this. Can be computed by reversing these calculations. So, for example, what is the present value of $1,000 to be received in 5 years when interest is compounded, the interest rate is, let's say, 3% compounded continuously. So what you're going to have is 1,000 e to the minus 0.03 times 5, or 1,000 e to the minus 0.15. And that will be my present value. So let me do that on my real calculator. I've got 860.71. So that means if I put that much in the bank now, assuming the bank pays 3% compounded continuously for the next 5 years, I'll reach my target of $1,000 in 5 years. So the value of any security in the marketplace ultimately comes down to its present value. That's what you're paying for. When you buy any security, you're paying for the present value of its future cash flows. So all assets in the economy can be priced with present value concepts. What makes it challenging, of course, is the uncertainty associated with those future cash flows. But let's say you're pricing cash flows that are certain, then this is all you have to do. And with these option results, because the results are enforced by this no arbitrage principle, we can therefore use the risk-free rate of interest to discount all those cash flows because they're guaranteed to happen. We can prove it too with our these conditions that we're developing. So therefore, all option pricing models will always use the risk-free rate of interest to discount cash flows. But as far as the continuous compounding part is concerned, in practice, you don't really see that very often, but they're mathematically more convenient than the rest, which, by the way, I forgot to mention, when interest is compounded, a finite number of periods or times per year, this is known as discrete compounding. In the special case, the extreme limiting case, when interest is compounded an infinite number of times per year, this is known as continuous compounding. So we'll always see this throughout Hull's book. He never uses any other conventions. He always uses, well, no, I shouldn't say that. For some products, the cash flows are defined with discrete compounding, but whenever possible, he always likes to use continuous compounding. Now, I'm going to show you an interesting example why this is so. You're going to look at this and say, oh my God, I'm surprised to see this. You're going to be, in fact, even kind of disturbed when you see what I'm about to show you. This is a brief, quick example why continuously compounded rates are actually a useful way of representing this information. Let's just say that you have the following scenario. An investor buys a share of stock. The next day, for $100. The next day, the price rises to 110. The day after, the stock falls to 100 and is sold. What is the investor's rate of return over the 2 days? Well, all right. Now, we're going to do this in two different ways. With discrete compounding. Now, in this case, this is 2 trading days. So we're going to do daily compounding. We're going to have day one, the return, we'll call it RT. Remember the price, by the way, we're going to, P0 means the initial price. The next price is 110, and the next day it's 100. So the subscript represents the day in which this price was observed. This is today, next day, and the day after, I guess we'll call it. So the return on day one is P1 minus P0 over P0. It's just a percentage change from day one to 0 to day one. So in day one, we made 10%. Day two, that's going to be a loss of 9.09%. So we have, according to this, a total gain of 0.0091. Oh, well, that's weird because it went right back to the original price. Now let's look at continuous compounding. All right, so what would be different? Now remember, P0 is 100, P1 is 110, P2 is 100. Aha, now you see what's different here. We're going to take the natural logarithm of 110 over 100, which is 0.0953. Day two, you have the log of 100 over 110. Negative 0.0953. It's zero. So in other words, the issue here is that the discrete compounding introduces a bias into the returns over time. And so when rates of return are calculated over long periods of time, we don't normally use discrete compounding because it introduces problems, whereas continuous compounding actually tells us, it takes into account the fact that you're calculating a return based on a different starting point. So this is one of the advantages of using continuous compounding with rates of return. And so this is one of the reasons why we do this with the derivatives markets, because it's mathematically more convenient. And it just has, you get rid of the issues that you run into with discrete compounding. So anyway, so you'll see in all of Hull's models, yes. So E is used to calculate so for the present value of a sum, P would be the sum of the principal Principal is the amount that you started with, or you're saving for, I should say. So E, of course, is a constant that's approximately equal to 2.71828. R is the annual rate of interest. T is time. The future value would just be principal times PE to the positive RT. The natural log would be used to calculate rates of return over two different periods. Okay, so by the way, the natural log you remember from high school, remember you learned about logs, you had log base 10, let's say of 1,000 would be 3 because 10 to the third is 1,000. You would use this for things like, when there's large numbers, like the Richter scale is a logarithmic scale. When they tell you that the Richter scale is 7, it really means 10 to the 7th power. So natural log is the log to base E. That's the connection between the two. It's the log to base E. So think of E and log as in a way they're inverses of each other. They offset each other. So in other words, what I can do is the natural log of E to the X is simply X. They're inverses basically. So the log would be used to calculate, let's say I buy a stock today for 100 and I sell it for 120. The log would just be the rate of return over that period. Whoops, I forgot the log. We're going to run into this in the option pricing models, by the way, so we may as well go over it now. Okay. Oh, I copied the wrong thing. This was supposed to be 100. Whoops. 0.1823. 18.23% on a continuously compounded basis. Yeah, it's pretty nice, isn't it? Yeah, it's got its advantages. In fact, some people have suggested we should use this with the exchange rate or currency markets because when you're dealing with ratios, you run into the same type of bias. So it has its place, definitely has its place. But a lot of normal financial products you see in the market are not calculated using continuously compounded rates. But what's interesting about this is that American banks will typically compound interest on a daily basis. The difference between daily compounding and continuous compounding is very, very small. They're almost the same. You'd have to have a very large amount of money to notice the difference. So by using continuous compounding, it's not too much of a stretch compared to what's happening in practice when there's daily compounding. But anyway, so what this indicates is that the return to the stock is 18.23% on a continuously compounded basis. But all right, anyway, so we got a little bit off the track here a little bit, but let's see, what led it to? Oh, the present value. Yes. Why is this present? What is this all? X e to the minus RT then is the present value of this strike price. Now, if we're going to replicate this with the security in the market, you can think of this as the price of a treasury bill. Now, I just want to mention again, as a quick aside, if you're not that familiar with the treasury market, treasury notes and bonds pay coupons to investors. Treasury bills, on the other hand, are sold at a discount to the face value and redeemed at the full face value at maturity. So let me show you an example of that. Let's say that, for example, I buy a 1-year treasury bill with a face value of $1,000, may sell for $9.82 in the market. The investor will pay $9.82 today and receive $1,000 in 1 year. The return is therefore $18 over $9.82 about 1.83%. Now, this is discrete compounding. Now, if we were to try to figure out what this is with continuous compounding, then what you would do, the equivalent continuously compounded return would come about by doing this. But in the treasury market, you don't have continuous compounding. This would be a 1.83% yield or rate of return. So you'd have the log of 1,000 over 1982, or 982, what am I saying? Oh, you don't need the one. Sorry, you don't need to subtract them. It would just simply be 0.01816. So the thing is, either way you look at it, you're going to end up spending $9.82 now and ending up with 1,000 in the future. So the fact that this one is 1.816% and the other one is 1.83% doesn't matter because the compounding conventions are different. The ultimate result is that your 982 eventually turns into $1,000. So in these arbitrage arguments, we're going to use the continuously compounded rates again for simplicity. And so when you see something like this x e to the minus RT, like here, for example, if I were told up front that R is 0.01816, and this is a 1-year investment, that means that except for rounding, that should bring me back to the 982. Yeah, it's like 981. There's a lot of rounding. It's like 981. Like there's more rounding than I realized. It's just under. It's approximately correct. I just shouldn't have rounded it so much. A lot of rounding brings it back to 982. All right. So the government doesn't price bonds. What happens is the treasury bonds and notes that I mentioned, let's say, for example, actually, let me just take a detour here. There's actually three types of securities available in the treasury markets. Hold on one second. We have treasury bills and maturities up to 1 year, treasury notes, maturities of 2 to 10 years, and then treasury bonds have maturities of 20 to 30 years. Oh. Okay, up to 1, 2 to 10 years, and 20 to 30 years. Now, the treasury notes and bonds behave very much like corporate bonds in the sense that treasury notes and bonds are sold at the full face value. They provide coupon payments during their lifetimes and then are redeemed at their full face value. So you're basically lending the government, let's say $1,000 for 30 years. They give you interest payments or coupon payments, and then in 30 years, you get your money back. The price is whatever the bond is selling for in the market. Now, once the bond is issued, then the price can fluctuate. Okay, so in other words, the value of the bond, the price of these can fluctuate every day after they've been issued. Because market rates can change. Now, why does that matter? The value of any bond equals the present value of its remaining cash flows. So if interest rates change, the cash flows are fixed, but present values will change. So in other words, every day in the market, interest rates will change, and that'll affect not the actual cash flows, but their present values. Ah, here we go. We have a hand over here. I couldn't see that before. I hope it hasn't been up there for 20 minutes.
No, actually, I just put it up. I've got tired of typing in the chat. So I was just wondering, so what is the common way of doing it on the market? Is it continuous compounding or is it discrete compounding?
It's definitely discrete. You don't normally see continuous compounding in the marketplace. But remember, a lot of these markets have been around for a very long time. And so we continue to use the same conventions that we've always used. It's very rare that you see any real changes. Each market has its own unique set of conventions, and they typically continue to be used, even though there might be others conventions that might be more make more sense. Just as a quick example of this, one of the really big headaches with any kind of interest-bearing security is the timing of the cash flows, because the year doesn't have an even number of days. So what'll happen is decisions have to be made about when the cash flows are actually paid out. So like most bonds make coupon payments twice a year. They're called semi-annual coupons. But that means that you're never going to have the exact same number of days between coupon payments. Some years, or like one coupon might come on, let's say January 1st, and then there's July 1st. Depending whether it's a leap year or not, there could be 182 days in there, 183, 181, whatever. And then the next one after that might be the next January 1st. So the number of days between coupons can fluctuate. So a series of conventions have been created in the bond markets. And in some of the markets, a decision was made to treat each month as if it had 30 days and the year as if it had 360 days. So in those markets, like the euro currency markets behave like that. It means that if you're owed a coupon in 6 months, it's actually going to happen in 180 days exactly. even if that's not going to bring you exactly full 6 months. So the conventions that we've seen have pretty much been around for a very long time. So a lot of them are very old. They go back to a day when there were no computers to do all the grinding for us. So some of the calculations that we see are actually not correct, but they're easy to implement. And so they're a holdover from ancient times when there were no computers to do all the calculations for us. So no, we do not see continuously compounded rates, even though that might make sense. That just isn't how it's done. The financial markets are actually quite conservative. In fact, it took until surprisingly recently to switch stock prices from fractions to decimals. You'd be surprised. Throughout U.S. history, stock prices were based on fractions. Like if you look at a ticker tape from, let's say, the Depression, the ancient machines that were used in the 20s and 30s, these are basically the Bloombergs of their day. And this is how people got their stock price information. If you look at the tape very closely, you'll see, if it ever wakes up, that the prices are quoted in fractions. Jesus Christ, I don't know, the net is just so slow tonight. Oh God, okay. I don't want to waste all night with this. Oh, here's one. Maybe we can see this one. Yeah, I'm not seeing it on here. All right, I'll tell you what, let's go to Google for a second. When were stock prices converted to decimals? I'm going to say the early 90s. No, oh my God, 2001. Up until that point, they were quoted in 16ths. Can you believe it? Now, this gets us diving off into economic history. Now, all right, well, since we're having fun with this stuff, we might as well talk about it. In the early colonial days, there were constant shortages of gold and silver to make coins. The British tried to starve us of gold and silver to make our own coins. Now, Spain still had a presence in Florida, so a lot of Spanish coins made their way into the United States. And one of the more popular coins was the real. And these silver coins were worth $1, but they were split up into 8, or each one of these is worth 8 reals. So the Spanish monetary system was based on eighths. And so doubloons, for example, were actually physically, you could actually, in order to make change with these coins, especially at a time when there just wasn't enough change in circulation, you could take one of these things into a store and buy something with it. And in order to give you change, they would be willing to cut it up to 8 equal pieces. In fact, I think we can get a picture of a Spanish silver dollar, or 8 real piece, it's called. Where it's actually been done. So this is a Spanish silver dollar that circulated at that point in time. And again, it was out of sheer necessity. The US didn't want to use foreign coins, but this is what they look like. And they were circulated side by side with American money. but they're very valuable. So most transactions that you made, you would need to get some change. And so if there wasn't enough change, the store owner could just literally take out an axe and cut it up into 8 pieces. God, I can't seem to find a picture of one. But anyway, the point of it is that the Spanish monetary system was based on eighths. And I don't remember exactly why, but and then the coins were free. It was a common practice to cut them up into 8 slices, basically. And so because of that, prices came to be quoted not so much in dollars, but in eighths. Okay, in other words, the price of something you might walk in the store, it might be 3/8 of a dollar for this, 5/8, whatever the case may be. So once stock trading got started, it was not a strange thing to see stock prices quoted as so many eighths, like 3 and an eighth or something like that. So it was our early history with the Spanish coins that led our stock prices to be quoted in fractions. And so that practice lasted, surprisingly enough, up until 2001. But anyway. So that's an interesting bit of history. I was unable to find a picture of one of these coins already split up, but they do have them in museums. All right, well, anyway, so, oh, and by the way, so now this limit, upper limit for a put price, what we're claiming here is that it's not just going to trade for a price less than the strike, it's actually going to trade for a price less than the present value of the strike price. And so what that means then is that, like in this diagram that we've seen for puts, where were we? Here it is. Yes. So what this means is that when you're drawing one of these curves, this lower limit is actually going to tell us how far the price can go. Now, if this relationship is violated, now remember, we're claiming that P is less than or equal to. So a violation would mean that it's not true, that the price of the put rose above this point. So all we'd have to do is sell the put and then buy this treasury bill, paying this price for a treasury bill that's guaranteed to be worth X dollars at time T. Okay, so what you're actually buying is a treasury bill. And then, let's see. So let's put together a little chart. So the upper bound and then if buy a treasury bill with face value X, sell the put. So let's look at our scenarios. So at maturity, either the put is in the money, which means that the stock is less than X, or the put is out of the money. Well, actually, I shouldn't say out of the money. It could be at the money. So in this case, we own the T-bill, which is guaranteed to be worth X. We sold a put So therefore, the payoff to the put and therefore the total value of our portfolio is S, which is positive. Whereas over here, the T-bill is worth X. The option is worthless. The put payoff is 0. So the total is X, which is still positive. So we made money in both directions. When we set this up, and then the maturity date, which again is extremely unusual. But anyway, so all of these work the same way. We don't have to go through every single one of these, but there's a couple here. Like here, for example, there's a lower bound. Actually, I think we should do this one because we're going to need this in our pricing discussion next week. So what this is saying is that for European call, the price has to be at least this amount. It cannot fall below that. So in order to prove it, this is equivalent, by the way, algebraically, these are equivalent to each other. So let's say that the opposite happens. Well, we sell S and we buy C, the right-hand side. Now, this one is more complicated. So what I've done here is I've set up a little table to make it easier to keep track of what's happening. Well, I don't know if it's more valuable. It's the option prices will reflect those lower interest rates. So these conditions are never we can never actually violate these, no matter how you look at it. But what happens is different types of strategies will work better under certain different conditions. So like certain types of trading strategies make sense when interest rates are crazy low, and others make more sense when rates are at normal levels. Like, for example, in the currency markets, there used to be a strategy where you'd borrow yen, then you convert them back into dollars and invest them in the United States. And then at the end, at some point in the future, you repay your yen loan. And you can make a lot of money that way as long as the Bank of Japan did not allow the yen to appreciate too much. And so, for the time, it was a very sensible strategy, but now conditions have changed so much that it might not make any sense anymore. But anyway, so imagine that we set up two portfolios. This portfolio is the call plus the treasury bill, which will be worth X dollars for sure at time T. And the second portfolio is the stock only. So what we're going to demonstrate is the two portfolio values in the future. And so they will be based on, in the first case, the call is in the money. And here the call is out of it's at or out of the money. Oh, I already had it down here. Okay. So let's call these portfolios A and B. So if the call is in the money, it'll be worth the payoff of ST minus X. We have the treasury bill, so our portfolio is worth ST dollars. On the right-hand side here, if the option finishes out of the money, we still at least have X. For the portfolio B, the S, well, it's just a stock. Well, that couldn't be any simpler. Now, if you notice though, in the second scenario, the stock is worth less than or equal to X. So in the first scenario, portfolio A is worth the same as B. In scenario 2, A is worth at least as much as B. Now, why does that matter? Because their strategy was to buy A, what we were calling A, and sell B. So in the beginning, we're collecting. Now, if you notice, when we set this portfolio up, we're making a profit because we're buying the right-hand side and selling the left-hand side. So a profit is the difference, and it's positive. So the question is, what happens in the future? Well, we bought the portfolio A and we sold portfolio B. A, the one we own, is always going to be worth at least as much as B, and it might be worth more. So that means either we'll have no cash flows in the future, or else we'll have a positive cash flow. So either any way you look at it, this is going to make us money. So the bottom line is then what we've proven is that no matter what happens in the market, the call price cannot fall below S minus X even minus RT, which means the present value of the stock price minus the present value of X. So you can see that in the markets, the lower bound is set by not X itself, but the present value of X. Oh my God. Now, there's so many of these. You couldn't believe how many of these relationships can be derived this way. There's all kinds of crazy results. So what I would like to focus on, though, and maybe we'll come back. By the way, there's a little table here I put together just to keep track of all this stuff. Because we don't have all night, what I really, really need to focus on without fail. Oh, by the way, I just want to mention that because these are meant to be stock options, this table is basing the assumption that no dividends are paid. If dividends are paid during the lifetime of the option, then the chart has to be adjusted, and we'll see it down here. So there is a difference. Now, this D, by the way, is the present value of the dividends, not the actual dividends. But the most important topic is what's coming up next. So we'll do that first. And if we have time, we can circle back to some of these other relationships. But the advantage of spending all this time here is that what I'm about to show you will make perfect sense. But what you have here is a graph that shows not just the payoff to a call option, but that's the red line. The black curve above it is the market price of the option. Now, if you look at these prices, for example, let's just randomly pick the 120 strike call. Now, the price of the stock is only 153.83, which means that the difference between this price and this strike is 33.83. Whereas if I could exercise this right now, my payoff would be 33.83. But the price is actually 36.64. What happened? So this diagram shows us that the gap between the market price curve and the payoff curve or payoff profile is called the option's time value. You're paying a premium. Like this one, remember, it was 33.83. So the extra $2 and some cents is the time value of the option. What it represents is the possibility that the option could move further into the money by the time it matures. That's what the time value is. So the payoff, the value is called the intrinsic value of the option because it cannot fall below that. The market price of the option cannot fall below the intrinsic value. Otherwise, there'd be an arbitrage. So the market price will typically be consisting of two things, the intrinsic value plus the time value. Those two will collectively give me my market price. Now, a lot of the factors that we saw earlier that affect option prices are really affecting the time value more than anything else. So this is an important graph to understand. And we'll discuss it again as we go along. The put, same thing. Now, this is the American put. And you can see that there's going to be, for every put, there's going to be both the intrinsic value or payoff and the time value, which collectively adds up to the market price. Now, here's one of those quirky cases where the passage of time could actually be harmful to an option. This is an American put. By the way, this graph is for calls, whether they're American or European, it doesn't make any difference. The distinction matters with puts. Here's the American option. Now look at the European option. It turns out that when you're getting down in this area here, the put option is very deeply in the money. It's almost guaranteed to finish in the money. And if you notice that black market price is suddenly fallen below the red payoff profile, and within that band there, the time value is actually negative, which means that if you could exercise this option now, you certainly would, but you can't. You're stuck hanging on to it until the maturity date. And so because of that, your position is actually losing value. Now, here's, I can see I've sketched in some numbers here so you can think about it. What if the option is $100 in the money? The risk-free rate is 3%, which means I could earn 3% interest if I could exercise this option right now, but I can't. The option matures in 1 week. So if I could only exercise the option now, I could earn 5.77 cents between now and the maturity date. But if the time value is only 3 cents, then it means I'm actually losing 2.77 cents by having to hold on to it to the maturity date. So within that narrow range there, the time value is actually negative. Now, this is something you see very, very, very rarely. But what this means is that if you find an option, a put option, where the market price is less than the intrinsic value or payoff, then this is what's happening. So this is a very rare but possible case. Now, oh, one more thing. I do want to point out here, let me draw a little picture to show this next part. And we'll discuss this again in a later chapter, but let's say that you have a call. And yes, their behavior gets very strange. We'll see more of that next week. Especially when they're at the money. They're very close to being at the money. Because then nobody knows whether they're going to end up in the money or at the money. So their value can fluctuate dramatically as we get closer and closer to the maturity date. So here's the call. And let's say here's the market price. When, let's say, there's 6 months to maturity. What happens is, as time elapses, the price converges to the intrinsic value. 3 months, meaning 3 months until the maturity date. And so as time elapses, we're getting closer and closer. Let's say this is 1 month. And on the actual expiration date of the option, it will coincide with the intrinsic value. So the market curve is shifting to the right and the time value is shrinking to 0. And on the actual maturity date, it will be 0. The value of the option will be 100% from its payoff. So the market price is going to be affected by the passage of time in the sense that the time value is shrinking as we get closer and closer to the maturity date. In fact, if you look at these guys here, with this current batch of options, where the maturity date is like 4 days from now, the payoff to this one. Now let's use this one as an example here. So it's about $2 and some. Let's figure this out. It's the price is 153. $83. The strike is 120. So that's 33.83 is the intrinsic value. The market price of this thing is 36.64. So that leaves us with a time value of $2.81. Now that sounds like a lot to me, considering there's only a few days left. If we come back tomorrow and look at the same quote, you can rest assured that that number will continue to shrink. And if the market price doesn't change on the final day of trading, this option will have to sell for 33.83 because that's the intrinsic value. There's no time value left on the maturity date. Otherwise, again, there'd be an arbitrage. So anyway, what I really want to go over is the so-called put parity condition. This is really, really important. We'll see it all the time when we're pricing options. It turns out that if you have a European call and put that are identical in every other way, there's this very specific relationship between their prices that must hold to avoid arbitrage opportunities. And it's very straightforward, actually. Let's take a look at it. And it'll start to make sense when you see it. Well, all right, I'll tell you what, I guess I saved it after the derivation. I'll just write it in right here. So what we're seeing here is the present value of the treasury bill, whose face value equals the strike price, which we're assuming that both options have the same strike price. S is the stock that they're both written on. T is the common time to maturity of the two options. And then P is the put, of course, and C is the call. This is what the put call parity condition is telling us. And if it is violated, there'll be arbitrage opportunities. So what we're going to do is actually rewrite it slightly. And what we're going to do is basically just show that if I set up a portfolio, we can think this is portfolio A and B. We can prove that in the future, on the maturity date of these two options, portfolio A and B must have the same value. If that's true, then they must sell for the same price today to avoid an arbitrage. Okay, so there's two assets that must be worth the same amount in the future, must have the same price today. So I'm gonna show you how this is proven. We're gonna set up a little chart, and it's getting a little cluttered here, but we have portfolio A and B. Okay, there it is up there. And all we want to do is demonstrate that no matter what happens, in the first scenario where the call is in the money, in the second scenario, the call is out of the money, what happens to the two portfolios? So in the first scenario, portfolio A, the stock price, by the way, this little capital T here is meant to mean that that's the price on the maturity date of the two options to distinguish it from today's price, which is simply S. So in other words, when the options mature, it'll be time T, and we're going to call the stock price ST. So the stock price is ST, whatever it is. The put is out of the money. This put is out of the money. It has a payoff of 0, so our portfolio is worth the price of the stock. If the call is out of the money, the put will be in the money, and so the payoff is X minus ST. We combine that with the stock price, and we end up with a portfolio worth X dollars. Portfolio B, in the first scenario, the call is going to be exercised. Payoff is ST minus X. We already have X, that's our treasury bill. So the total value of this portfolio is ST. And over here, we have the put payoff of 0 because the put is out of the money plus the treasury bill, and we end up with X. So what the important thing is that in scenario 1, both portfolios are worth ST, and in scenario 2, they're both worth X. So that means that in the future, on this trading date, when both options mature, portfolio A and B are guaranteed to be worth the same amount of money. So it must be true that we can buy them today for the same price. Otherwise, what you would do is you'd buy the cheaper one and sell the more expensive one. You keep the profit, the difference, and then in the future, cash flows would exactly offset each other. So, for example, and by the way, like here's some case, they're going to show you here like exactly what you would buy and sell, which is fine, but we get the principle that you're buying whatever is too cheap, you're selling whatever is too expensive, you put the difference in your pocket now, and in the future, at least in this case, the cash flows offset each other, so there's no risk. And so that guarantees that this will hold, this put call parity condition will hold. Now, we'll see how valuable this is next week when we're looking at the Black-Scholes option pricing model. It was a path-breaking model that was published in the early 70s, and it was designed only to price European call options, and even then only on non-dividend paying stocks. And so what happened was it became clear that there wasn't a need for a separate model for puts because of this wonderful put call parity condition. And so this proves to be hugely helpful when we price options. Now, if the underlying asset is a stock that does pay dividends, we have to make an adjustment to our put call parity condition. All of a sudden, we have this. We have to introduce the present value of the dividend to make this thing work. So we won't be using this example very often because this only applies to stocks, common stocks. There's a much more general case that we'll need to consider though, because most of the assets in the economy that we might write options on may provide some kind of a cash flow to the owner. And so how would we apply that to this model, to this framework? Here we go. I'm going to show it to you right now. So we're going to make the heroic assumption that, let's say we're writing an option on an asset that provides us with some kind of continuously compounded cash flow. The classic example of this would be a currency. If I own a British pound, I can put it in a euro sterling account and earn the British rate of interest. And even though I'd be earning an interest rate that's compounded daily, this is very close to the continuous rate of return. So what I can basically do is claim that the British pound that I own is providing me with a continuously compounded rate of return. So I can then use the following version of put call parity. And if you notice here, I've circled the difference from the original condition, and that Q is the yield or rate of return to the asset in this equation. So let's say S is a currency and the return to that currency is Q, then this is how I express my put call parity condition. So the original put call parity condition is wonderful, but it only works if the asset doesn't provide any income to the owner. If it does, then we have to take that into account, either a discrete dividend, like we saw here, which is only paid once in a while, or a continuously compounded cash flow like we would get with currencies. Okay, so no matter which condition we're in, we can always create a put call parity condition that ties together the prices of European calls and puts. Now, none of this works for your American options, sadly enough, but for European options, the put call parity condition is hugely helpful because again, it means that we don't need a separate model for our for puts. Okay, and so we now get the idea that if something like this is violated, there's going to be arbitrage opportunities, and we'll run into this over and over again. So that's the one I wanted to make sure that we cover because we're going to need this very frequently in the future. A lot of this other stuff is interesting, but it's still very theoretical. Upper and lower bounds, we're not likely to run into those in the marketplace, but it's nice to know that. Now, here's a very peculiar result, which might make you wonder what's going on. This is more of theoretical curiosity, but it turns out, oh, go ahead.
Yeah, I was wondering if you can calculate upper and lower bounds, including volatility or just like hypothetical volatility.
Well, but the thing is, these are going to hold regardless of what the volatility is, because the call and put prices already reflect the volatility. So in other words, if you notice that the upper bound or the lower bound is this, it's like basically there's some level that they can't reach regardless of, it doesn't matter if the volatility is 1,000,000%. This is as high as it can go because if not, again, there would be an arbitrage. So the volatility isn't really part of this because we're basically saying here's the limit to how far you can go, period, no matter what's going on with your volatility. So yeah, the volatility is not part of these upper and lower limits. Now, having said that, the call value will depend on it, but it just means that no matter how high the volatility goes, the call price cannot rise above the upper limit or fall below the lower limit. So, but anyway, so as I started to say, here's one of the most peculiar results you'll ever hear in your life. Getting back to the idea that some assets underlying a call will have cash flows and some will not. It turns out that Let me see if I can find it. This is really more an intellectual curiosity, although it'll prove handy next week. If you have an American option written on an asset that provides no cash flows, it turns out that it will never make economic sense to exercise it early. Now, why is that? Intuitively, what's happening is that when you exercise an option prior to the maturity date, you are gaining the opportunity to invest that money at the risk-free rate of interest, but you're also losing the option's time value. So that being the case, let's actually think about what would happen if the asset did have a cash flow. If you exercise the option to buy it, you're giving up the time value, but you're also gaining the asset itself with the cash flows that come with it. But if there's no cash flows, then you're losing all the time value and you're getting nothing in return, basically, except maybe the opportunity to sell the asset and earn a little interest. So what that means then is that if you have an American call on, let's say, a non-dividend paying stock, it will never make sense to exercise it early. And so because of that, the price will equal the price of the equivalent European call option. This doesn't hold for puts. For puts, it always makes sense that an American put may be exercised early. There always might be circumstances, even if there's no cash flows coming from the asset, where it pays to exercise it early. But with calls, it's the other way around. If it's an American call and the asset does not provide any cash flows, then it will never make sense to exercise it early. We'll always be better off selling the option to somebody else rather than exercising it early. Okay, so let's see. Yeah, let's see, what are they saying here? We've already seen the lower bound. This part we've already seen, which is greater than this number, which is the payoff. Yeah, there it is. So think of these as, let me put a new slide here. I think the way to best explain this is to say this. So this is the value if exercised early. And this is the value, the minimum value, if not exercised early. Although the way it's written, I think what they're basically claiming here is that if you notice that if the rate of interest was 0, then yeah, I guess what they're claiming that isn't going to happen. So, but most of the time, this piece, the value if you do not exercise, the minimum value, I should say, is always going to be greater than the value if exercised. And therefore, the call will always be worth strictly more the way this is written, as long as R is not zero. Combining these means that now this is the value if sold to somebody else. This is the market price. And this is the, you know, the intrinsic value, which means this is what you'll get if you exercise it. So it's kind of hard to wrap your mind around, but just the idea that you do lose the time value when you exercise early. And unless you're going to get some cash flows to make you compensate you for that, it will never make any sense. That's pretty much what this is saying. So without cash flows, then you're never going to exercise. Now, if there are cash flows, well, that changes everything, because then all of a sudden, this S would be replaced with SE to the minus QT, and that could change our results. So here there's no cash flows, therefore we're guaranteed that we're going to be making ourselves worse off if we exercise it early instead of selling it to somebody else. So that will be an important result when we look at pricing next week, because whatever the price is for American call, we can just use that for a European call and vice versa. All right, is there anything else really critically important in here? I don't know, I think we're okay here. So what's going on next week? Let's take a quick peek at next week. We're going to do a ton of Excel, by the way, once we get into week 6. We're going to introduce one of the most path-breaking results in all of financial history, which is the so-called Black-Scholes model. You may have heard about it. It's so famous. Black and Scholes were researchers who were trying to figure out a model for pricing options, because it had eluded people for centuries. Well, I don't know about centuries, but for the longest time, researchers were trying to figure out how to price options properly, and they couldn't seem to come up with a model until Black and Scholes came along. And so it proved to be hugely important, although at the time they didn't recognize themselves how important this would prove to be. And they wrote a paper later on which they talked about their experiences, and they were just two academics who were sort of working on this paper. And before you knew it, they were two of the more important people in the financial world. And in fact, later on, they added somebody to their team named Robert Merton. And so this paper was published in 1973, and it became immediately obvious that something important was here. And so suddenly options pricing went through the roof, because traders were suddenly able to understand what they were actually worth. So about 20 some odd years later, after unfortunately Fisher Black had died, Scholes and Merton ended up being awarded the Nobel Prize in economics for this. Just to show you how important this is, the Nobel Prize in economics, that's rather a big feather in their cap. And they revolutionized derivatives pricing. They really did. And so this model, as complicated as it is surprisingly simple to implement in Excel. So that will help us. We'll enter the model in. I've already created templates so we can do this very quickly and easily. But we're going to try to make some sense out of what the model is telling us. And then, now here's the problem though with Black-Scholes. And at the time, it didn't seem to be so important, but it only works with the European options. At that time, there really weren't that many American options anyway, but now most options are American style. So later on, other types of models had to be developed to explain how to price American options. And there are quite a few of them. We're going to look at one of the more important ones. It's more work, of course, but at least we can price American options as well as European options. And by the way, people still use this Black-Scholes model 50 years later. In fact, now that I think about it, it's the 50th anniversary of Black-Scholes this year. How did I not think about that? I wonder what if something's going to be done to honor them. Wow, this is a huge deal. I know they're still alive. Oh, yeah, well, at least we'll have a conference. This is how it's done in academia. There'll be a conference. I imagine they're going to invite Merton and Scholes. I mean, they're the men of the hour. Ah, here we go. Book your free ticket. No kidding. I wonder if I should go to that. I had no idea. This is great. So who's coming? No, that's Scholes over there on the left. I reckon. No, that's not him. What happened? Oh no, they're not even going to be there. Oh, I see. It's free if you're a member. Oh, okay. Still, I mean, wow, that's pretty wild. You don't see that very often. Yeah, I guess Myron and Bob are not available. Let's just see if they're still. Yeah, he's still there. Oh, no, that's not the same Merton. Here he is. Yeah, he's still alive. Okay. All right. Well, there they are. Anyway, so we're going to dive into that next time, and then we're going to look at the models that are needed to price American style options. And then the week after that, we're going to look at risk measures in option pricing because, let's face it, options are designed to help us manage risk. So we need to have measures to help us understand just how much risk there is for each option that we own and how we can use our options to help reduce these types of risks. So that'll be very interesting. So, but anyway, I guess, like I said, there's no assignment for tonight because this material is way too theoretical. So, but then we'll make up for that next time when we do all these wonderful spreadsheets, which for the most part have been set up for you, but we're still going to need to spend a lot of time working with them and understanding what they're telling us. So anyway, I guess if there's no last minute questions, I guess we'll have to stop right here. It's kind of sad that we have to stop, but we do. Oh, there's Larry.
Yeah, sorry to ask one more question here.
Sure.
I really am still having trouble with the concept from that assignment that you gave when you write a call and you're
Yes.
trying to figure out the payoff. And the way I figure it is when the stock price drops, you're actually winning if you write the call. And when
Yeah,
you put
that's
it in the
right.
formula,
That's correct.
yeah, when you put it in the formula, it doesn't seem to give the right answer, and I'm trying to wrap my head around it because the book does it that way as well, and I just don't understand that equals max concept when you write the call.
Oh no, but it's negative max because you're the writer.
Oh, it's negative max.
Yes, that's why.
Okay, I just didn't see that. Okay.
Oh no, that's maybe there was that's a danger with negative signs. They're so tiny, it's easy to overlook them. That's why all you do is put a negative in front of it, and it becomes you buy a call, it's max S minus X 0. You sell a call, it's negative of max X minus S minus X and 0. So you're just making it negative. That's all.
Okay, I think I may have gotten some of them wrong. I didn't see that negative sign.
Oh, okay. Well, I'll look at them. And then Felicitas.
Is there any way you could upload the videos from last class in this class as well?
Oh, well, I have some terrible news for everyone. Last week, now I use the Zoom system for different schools, and this is the only one where in order to record it, you actually have to go in up here into a menu and say, please record this. The others, it's automatic. So, well, you know where I'm going with this. I apparently forgot to do that last week, so unfortunately, it's gone. But this one is being recorded. I made damn sure of that. I was so aggravated when I noticed that, but that's because, you know, it's the other ones that I used, you don't have to bother with it. It's done automatically. This one doesn't seem to have that capability. So it's just not available.
Okay,
But this one is, I made sure of it. I won't let that happen again.
all right, thank you.
Okay. Anyone else? All right, so I hope this wasn't too frightening. Just be aware, you will need this again in the coming weeks, this background, especially the Pocal parity condition. But you know, I think, and going forward, we'll spend more time with actual deriving results, like actual prices. But it's good to know that going on behind the scenes, that all of these relationships are tied together with this no arbitrage principle, and that you know, you're not going to find deviations in the market, because otherwise they'll be corrected immediately. So we can have confidence in our results. So, all right, I guess I'll see you all next week then.
Thank you.
All right, good night.
All right, thank you. Have a good night.
You're welcome. All right, bye.
Good night.